What if I told you that keeping your money safe in the bank is actually one of the riskiest things you can do? Through 9 years of working in banking and now helping people with their personal finances, I've seen the same mistake repeated over and over. People keep tens of thousands in their accounts, feeling good that their bank balance is going up, thinking they're doing a great job of managing and saving money. But in reality, the complete opposite is true. There is currently over £526 billion sitting in low-interest accounts in the UK, earning virtually nothing. That is affecting the lives of 29 million people. And in the US, half of Americans have more than $8,000 sitting in similar accounts. All these people are losing money every single year, completely unaware. So, in this video, I want to share with you why having too much cash is one of the most dangerous mistakes you can make when it comes to your money. And we're also going to cover what you should be doing with that money instead. Let's get into it. First and foremost, cash is the laziest employee you will ever hire. You know that feeling when you've just finished another grueling week at work? You're working overtime, you're dealing with difficult colleagues, you're sacrificing evenings, maybe even weekends, pouring your sweat, your stress, your mental energy to earn, let's say £10,000, and you put it into a bank account. You check that bank account a year later, and your money is still sitting there, being lazy and not making any more money for you in that time. Not only that, but the money is now also worth less than it was a year ago. It's still £10,000, but you can buy less with it than you could before because of inflation. That's what happens when you keep your savings in a bank account. It sits there, doing nothing for you while you're working so hard. Now, if instead of putting that money in a bank account, you decided to put it somewhere else where it continues to work for you while you continue to earn money, it also goes out and makes more money for you. That is investing your money. If you put that £10,000 into something that generates an 8% return, and I'll talk about how to do that safely in a moment, after a year, it would have become £10,800. Then that £10,800 in the second year would have become £11,664. And every single year after that, you'd be earning more and more money from money that you are no longer having to work for. Over 10 years, your lazy cash that was doing nothing for you would have stayed at £10,000. But the money that you put out to go and earn more has grown to over £21,000. That is more than double. An extra 11,000 plus that you never had to sacrifice an evening or a weekend for, simply because you put your money to work instead of letting it sit in cash doing nothing for you. This is one of the biggest reasons why you don't want to keep more than you need to in a bank account, because you're just missing out on potential earnings. Moving on to point number 2, the emergency fund trap. I know what you're thinking. What about emergencies? You're always saying we need to save for an emergency fund. The purpose of an emergency fund is, in a worst-case scenario, if you lost all your sources of income, do you have enough savings that you can continue to afford your living expenses for the foreseeable future, to the extent that if there was an emergency, you wouldn't be short of money to afford shelter or food? And when you strip away everything else other than the core living expenses that you need to be thinking about, that's your mortgage or rent, your food, your essential bills, minimum debt repayments, whatever that total number comes to, times it by 3 for a basic emergency fund. Or, if you want more protection, times it by 6. Also, if you're self-employed or you have a volatile job situation, you can times it by 9. That is how big your emergency fund needs to be. It does not need to be any more than that. When I was working in banking, I'd have colleagues with £40,000, £50,000, £70,000 in their accounts telling me that's their emergency fund. But when we broke down their actual monthly living expenses, just the core living expenses that we talked about, their actual emergency fund was less than half of that. The rest of it was just fear money sitting there, losing value every single day. So, yes, save your emergency fund and make sure it's A, in a high-yield savings account, and B, easily accessible with no withdrawal fees. That's all you need for an emergency fund. Personally, I'm currently saving money for my emergency fund in Plum. They're offering around 4% on their easy access savings, which means it's super accessible and it's saving my hard-earned money from inflation. The link is in the description if you want to check them out. Reason number 3. and I made this mistake this year, is that it will feel like spending money. Having too much money lying around actually tricks you into spending more. If you think about it, you check your bank account, you see 15,000 sitting there, and your brain goes, "Oh, I've got loads of money in the bank account." So you buy that pair of shoes you've been eyeing, you go out for dinner instead of cooking. Maybe you book that weekend trip because in your head you're still thinking, "I've still got loads of money in the bank account. I'm still rich." But here's the thing. That £15,000 isn't actually for spending. Most of it is your emergency fund, or money you're saving for a house deposit, or just cash you haven't figured out what to do with yet. But because it's all lumped into one account and you see the size of that figure, it feels like spending money. I experienced this recently. I recently changed my bank account, and for a couple of months, I didn't set up my automation systems. And so when I earned money, it all went into one account. And I realized after a couple of months, my spending had gone up. I was making these impulse purchases that I wouldn't normally make because I could see the money just sitting there. So I had to quickly reinstate my systems where money gets invested directly from my business account before I even pay myself, and then I pay myself, and then from there it goes into other investments, my personal investments, into my bills, into my savings, and it's all automated. The key is making sure your money is out of sight before you can spend it unnecessarily. If it's automatically going into investments or into different savings accounts before you can even see it, you're less likely to make those impulse decisions. By the way, if you're watching this and you know you need to be doing more with your money, but you feel overwhelmed when you even think about how to start, I have a 6-week investing accelerator program coming up this October. It's designed to cover absolutely everything you need to create your path to financial freedom in just 6 weeks. And it will also, for the first time, include one-to-one sessions with me. You can find all the details in the link in the description and sign up if you'd like to join the waitlist. Moving on to the fourth reason, and that is because insurance will not cover you if you're saving too much. This is something that might really surprise you. There is a limit to how much the government will protect you for if your bank goes bust. In the UK, the FCSS will only cover you for up to £85,000 per person. In the US, it's $250,000 through the FDIC protection. So if you're thinking, okay, I'm nowhere near those limits, then you're probably safe. But if you are approaching or exceeding these amounts in a single account, you're just taking on unnecessary risk. You might be saving this money for a goal that's happening within the next 5 years, which is why you might not want to invest it. The solution is to ask yourself, why do you need that much money sitting around in the first place? The only reason you might need it outside of your emergency fund is if you're saving for a specific goal coming up within the next 5 years, like maybe a house deposit, paying for a wedding, buying a car. For that, the 5-year rule is important because the stock market can be incredibly volatile in the short term. Your investment could be worth $50,000 today, and then $45,000 next month, and then $55,000 the month after that. And if you need that money in 2 years for a house deposit, you can't risk it being down in value just when you need to buy. You'd be forced to sell at a loss, which pretty much defeats the whole purpose of investing. But for money you're not going to need for the next 5+ years, the short-term volatility eventually irons itself out over the long term, and so you benefit much more from the long-term growth. So if you have large sums for short-term goals, split that cash across multiple banks to stay within the insurance limits. But anything above your emergency fund that you won't need for at least the next 5 years should be invested so it can be growing for you on autopilot instead of sitting in an account where it's losing value to inflation and potentially at risk if you're over the insurance limits. And then moving on to one of the biggest reasons, and that is you become an easier target. If you are watching this and thinking, oh, that's fine, I don't need to worry about this point because it won't happen to me, I'm smarter than that, it's really not something to be complacent about. Scams are becoming incredibly sophisticated. They can even clone somebody's voice. And there was a tweet I read just this week. It was by Eric Bergman. He's a millionaire. He founded Greg.com. And he recently shared a story about how he got scammed. he received a call from Mr. Beast to donate money to Team Water to help build wells in Africa and help people get access to clean water. And he donated $1 million. And after a week, he gets a WhatsApp message from Team Water, the company that he donated to, and they invited him to join a group with Mr. Beast and some other billionaires for a trip to Africa. And after a week of back and forth in this chat group, Mr. Beast announced that he's got early access to a new coin-based crypto coin, and he wanted to share it with all of the big donors that were in this WhatsApp chat group. And then everyone got super excited. They started investing, and Eric said he didn't know much about crypto, but he didn't want to miss out. And so over 3 days, he sent $1.2 million in 3 different rounds to this coin. And just as he was about to invest some more, something